Since the beginning of May, shipments inbound to the U.S. have decreased by 14%, with inbound TEU volumes falling by 33%. These are just two of the numerous indicators that inventory levels have caught up with, and in some circumstances, are exceeding consumer demand. Shipments decreasing at a much slower pace than containers can mean that retailers are placing smaller and/or even canceling orders on previously backlogged items. Retailers such as Home Depot, Target, Costco, and Wal-Mart have all reported on recent earnings calls an inventory to sales ratio movement in the wrong direction. Supply chains gradually starting to become unclogged have also led to not only a downstream inventory surplus, but a surplus on several out-of-season SKUs. This may be beneficial to the average consumer as warehouse capacity remains tight and retailers mark down and purge what appropriate stock items they have too much of. Weekly jobless claims will be an important index for importers to keep an eye on as the overall labor market remains tight as the employed consumer continues to ignore the severity of the current sentiment level, even as it drops to its lowest point since February of 21. This is all in relevance to trucking, of course, as imports have a direct impact, lagging, but still a direct impact to first the truckload market and then eventually to LTL. Evidence of an already apparent slowdown in the spot volumes can be seen in DATS Trendlines data, reporting spot load posts down 13% with truck posts up 18% year over year. What should be an interesting telling sign of the severity of June's significant inbound TEU slowdown will be the strength of contracted freight volumes, now only a few percentage points below a robust 2021, according to FreightWave's Contract Load Accepted Volume Index. Biden's federal gas tax holiday would cut diesel costs by 24 cents a gallon, dropping current at-the-pump cost to $5.59 a gallon on average until the end of September. If you take into consideration the demographic that is suffering the most from the current inflationary pressures in trucking, the average 18-wheeler gets about 6 miles per gallon on average and will travel about 2,500 miles in a week. That roughly equates to $100 a week in fuel savings. With average at-the-pump costs up 80% year over year and the producer price index for general freight trucking alone up almost 30% year over year as well, this holiday would provide very little relief for those who need it the most. Now, state and local governments are also being called on to, and I quote, provide additional consumer relief. However, as we all know, everything eventually comes at a cost. And in this case, the cost would equate to $10 billion of what could directly go towards funding the Highway Trust Fund. Ultimately, this could slow the main way we fund infrastructure projects moving forward, which has been a massive concern for the current administration. This has been your Bridge Logistics Market Update for the week of June 27th, 2022.